Have you ever opened your retirement account options and immediately felt lost? Like you're staring at a list of investment funds that might as well be written in another language. You'll see names like large cap growth, mid cap value, international equity, or target date funds. And somewhere in the middle of all that confusion, one option keeps appearing again and again: the S&P 500 Index Fund. Now, maybe you've heard of it before. You see it in the news when the market goes up or crashes, or you hear people talk about it like it's something everyone is supposed to understand. But what actually is it? And more importantly, should you care? Because the truth is, the S&P 500 isn't just another financial term. It's one of the most important tools in long-term investing, and understanding it can completely change how you think about building wealth. Let's break it down simply. The S&P 500 is a collection of about 500 of the largest publicly traded companies in the United States. But it's not just a random list. These are companies that represent a large part of the American economy. When you invest in an S&P 500 index fund, you are not buying one company. You are buying a tiny piece of all 500 companies at once. To make it easier to understand, think about companies you already know. Apple, which makes iPhones and MacBooks; Microsoft, which powers computers and cloud systems; Amazon, which delivers almost anything you can think of; Google, which runs search and YouTube; NVIDIA, which builds AI and graphics technology; Meta, which owns Facebook and Instagram; Berkshire Hathaway, a massive investment company; Johnson & Johnson, which works in healthcare and medicine. These are not small or risky companies. They are some of the most powerful and influential businesses in the world. And the S&P 500 lets you invest in all of them at the same time. The S&P 500 is not fixed. It changes over time. Companies are regularly added and removed depending on their size, stability, and importance. Think of it like a constantly updated leaderboard of American business. If a company grows large enough and becomes influential, it gets added. If a company declines or loses relevance, it gets removed. For example, companies like Tesla were added after becoming big enough. And over time, weaker companies naturally get replaced by stronger ones.
If you looked at the S&P 500 from 30 or 40 years ago, it would look very different from today. In the past, industrial and manufacturing companies dominated. Energy and traditional businesses were much larger. Technology was a very small part of the economy. Today, technology companies dominate the index. Digital platforms and AI companies lead growth. Healthcare and financial companies remain strong. In other words, the S&P 500 naturally evolves with the economy. You don't need to guess which industries will win in the future, because the index adjusts itself automatically over time. This is one of the most important ideas in investing. When you invest in the S&P 500, you are not trying to pick winners. You are simply owning whatever companies become the most successful over time. The economy changes. Companies rise and fall. But the index updates itself, so you don't have to predict anything. Even though it includes 500 companies, they are not equally weighted. Bigger companies have more influence on the index. So when companies like Apple or Microsoft move, they have a bigger impact on performance than smaller companies. This means a handful of large companies can drive a big portion of the overall returns. But these companies didn't get there by chance. They grew by surviving competition, adapting over time, and staying relevant. Over long periods, the S&P 500 has historically returned around 8 to 10% per year before inflation. But here's the surprising part. Most actively managed funds fail to beat it. Even professional fund managers with teams of analysts, research tools, and complex strategies often underperform this simple index. Why? Because markets are extremely efficient. There are millions of investors and algorithms reacting to information instantly. So consistently beating the market is very difficult.
Now let's talk about something that quietly affects long-term wealth: fees. Actively managed funds often charge around 1 to 2% per year. That might sound small, But over decades, it adds up significantly. Because fees don't just reduce returns once, they reduce the growth of your entire portfolio year after year. Over time, this can cost hundreds of thousands of dollars in lost compounding growth. Now, imagine this. You invest consistently every month into an S&P 500 index fund. You don't try to time the market, you don't chase trends, you simply stay consistent for years. What happens next is powerful. Your returns start generating their own returns, and those returns generate even more returns. This is called compounding, and over long periods of time, it can turn steady investing into significant wealth. Yes, markets go up and down, and sometimes the drops can feel uncomfortable. But here's something important most people miss. Market downturns are not just risks, they are also opportunities. When prices fall, your regular investments buy more shares. Then, when the market eventually recovers, and historically it always has, those extra shares become even more valuable. So instead of fearing crashes, long-term investors often see them as chances to accumulate more at lower prices.
In investing, complicated strategies often sound smarter, but simple strategies often perform better because they remove emotion, they remove guesswork, and they allow consistency to do the work over time. The S&P 500 is powerful not because it is exciting, but because it is simple, structured, and built for long-term growth. The S&P 500 is not a secret trick. It is not a shortcut. It is simply a way to own a piece of the most successful companies in the economy and let time do the work. The real question is not, does this sound impressive? The real question is, can I stay consistent long enough for this to actually work? Because in investing, consistency matters more than complexity. Important disclaimer. This content is for educational purposes only, not financial advice. Always do your own research before making any investment decisions. If this helped you understand the stock market better, like the video and subscribe. It genuinely helps the channel grow and allows me to create more content like this for you.